Welcome to Advisor Office Hours on Financial Advisor Television. My name is Jay Coulter, and on this episode, we're going to discuss the Moodys Downgrade, recent economic data and how you should look at it as we head into the year end, and Thematic Investing with Chris Versace, the Chief Investment Officer of Tematica Research. Now, remember, this show is recorded live on all of our social media platforms, so that if you're catching this show live and you want to ask any guest a question, simply type your question into the comment sections. If it's appropriate, I'll pose it to our guests. But before we get started, are you tired of the bureaucracy of your current firm? Does your firm keep changing your compensation structure year after year? And are you uncertain about your options in the marketplace? Chances are you're a great advisor and you've built a great business, but it's just on the wrong platform. Learn how to gain clarity on your options, freedom from big firm bureaucracy, and better serve your clients with the Advisor Breakaway System from Resilient Advisor. Visit advisorbreakawaysystem.com and learn your options. Now, I want to bring on my good friend, longtime guest, Chris Versace, Chief Investment Officer at Tematica Research and the portfolio manager of the Action Alerts Plus portfolio over at thestreet.com. Chris, welcome back.
Hey, Jay, how you been?
Man, I can't complain at all. We're getting here into year end. Always a good time to start looking at economic data, what's going on, especially for advisors that are considering portfolio changes going into the next year. Last week, we got some news from Moody regarding the U.S. debt. What's your take?
Well, I guess the first question is, should we be surprised? And I say that kind of joking, but, earlier in the year, Fitch downgraded its ratings for the U.S. as well. So Moody's was kind of the last one to come along. But remember, though, Moody's didn't necessarily give a full downgrade, right? They revised the outlook to negative. But they did not really change their outlook for the long-term debt issuance, right? They still point to the U.S. economy and its credit worthiness. So, kind of reading between the lines, Jay, I view Moody's being like, hey, Washington, you're probably going to kick the can down the road again. You're very divided on what's going on. Interest rates are higher, right? Your ability, just like the consumer's ability to, service that debt becomes incrementally more expensive as you run up more debt. Get your house in order. Good God, people, if you were actually on like credit cards, you would be cut off by now.
So, Chris, I get asked a lot why I even bother to record things live, because lots of things can go wrong. Number one, we can get inappropriate questions that come in. Number two, the audio quality or video quality can start to degrade sometimes when we launch. I want to give you a chance to jump out, reload your browser, and come back in, because we're really not getting your audio coming through, and it's really important stuff we're going to talk about right now. So while you're rebooting that, I want to tell advisors a story that I've been telling very frequently. So if you find yourself in a spot where you're under duress, I'm talking about things from your personal life, not just business, and you can't seem to get out of your own way, it's incredibly important that you look for external resources to try and help you get better. And I want to tell an old story that Earl Nightingale used to tell. So it's the story set in the 1950s. Imagine a businessman walking home from work, has his newspaper under his arm, probably wearing a hat, walks into the house, and his young son comes running up and says, Dad, can we play some ball? The dad's tired, and he says to the son, I'd like to sit down and read the sports page for a little bit, but I have an idea. He opens up his newspaper and pulls out a picture of a map of the world, and he tears it into little pieces and throws those pieces on the coffee table. And he says, son, that's a map of the world. If you can put that puzzle, or once you put that puzzle together, we'll go play some ball. So the man sits down in the chair, opens up his sports page, and in very quick order, the young boy says, Dad, I'm finished. The dad looks down at the coffee table and in astonishment sees the map of the world is put together. And he says, son, how did you put that together so quickly? And he said, it was simple, Dad. We have a glass coffee table, and on the other side of the picture of the world was a picture of a man. If you put the man together, you put the world together. If you find yourself struggling with anything as it relates to your business today, make sure you take care of yourself first and put yourself together. Then you can start to put together some of the business problems that you might be having. A great story from Earl Nightingale. I've just found myself telling that story a lot to clients, prospects, and friends, quite frankly. So you can find that story in the Resilient Advisor book that I give away if you go to resilientadvisor.com. I'm going to bring Chris Versace back into the studio right now. Chris, thank you very much.
Sorry for the technical issues there, Jay. I wasn't aware that was happening.
Well, and I could vaguely hear what you were saying. I definitely want to go through that question again because it's important. Advisors today are getting asked about the Moodys downgrade. So let me set it up correctly.
Sure.
So an advisor's getting a call. They say, hey, I'm worried about this Moodys downgrade. What do we need to know? What do we need to be worried about? And especially for advisors, Chris, that have been building treasury ladders for the past year and a half, what do they need to be communicating to with their clients?
Well, look, for people who are nervous, I would just say, let's understand kind of what's going on and really what the Moody's downgrade was. And first and foremost, it's not like Moody's was the first one to downgrade. As I mentioned earlier, Fitch did something several months ago, and it caught some attention. But the market kind of rolled past. And I think for some folks, there's some renewed concern. Moody's is a much bigger name, kind of a weightier presence, or at least that's the perception. So you can understand why people are a little nervous. And, as we're having this conversation, the stock market is trading off, but there's a number of issues I think that are, driving that. But look, the bottom line, Jay, is going to be this. Moody's did not really alter their long-term outlet for U.S. debt. I think that's key for your audience to understand. Yes, we'll get questions in the near term about why the short-term downgrade. I think a lot of that, as I mentioned before, has to do with what's going on in Washington, the continued run-up in debt, higher borrowing costs just because interest rates are higher, and of course, the uncertainty given what's happened in the House, the round robin, if you will, of the speaker. This potential dual solution that they have going that looks like it's going to be dead on arrival. And here it is, November 13th. House is supposed to vote tomorrow on the 14th, and the deadline is the 17th. So a fresh round of uncertainty in the market. But, typically when we've seen these shutdowns in the past, they average, when they happen a couple days. I do think the timing as well as Moody's downgrade is going to light a fire to figure out some solution. But Jay, as you and I talk about, details always matter. A solution doesn't necessarily mean it's the solution. Odds are, I think, that we'll get the can kicked down a road, whether it's January, February, we will see, and then we'll go from there. But Jay, I can't tell you enough. This is just one thing we need to focus on this week. There's really a whole confluence of things that are going on.
Yeah, which makes the timing of you coming on so impactful here. So you sent over a bunch of great data and things that you'd like to talk about. You know what I think would be helpful? If you could prioritize what you think's important.
Oh, that's easy.
Head into this week.
I'll tell you right now. I mean, if you think of what happened in the last few weeks, the market rallied. The market is increasingly convinced the Fed is done, right? And, we're going to start having rate cuts sometime in the first half of the year. And there's a lot of noise out today from other bulge bracket firms kind of talking to that. I think one in particular has some ridiculous forecast, 275 basis points being cut next year alone, which, I would be surprised. Let's just be tactful and leave it at that. I could say, give me what they're smoking, but who knows? Anyway, so to me, what is the biggest data point to watch? It actually comes tomorrow. It's going to be the core CPI for October, which is expected to remain unchanged. That's the consensus forecast that the market has. You can look it up over at Trading Economics, great source of information. But if we look out at the Cleveland Fed inflation nowcasting model, they actually see it ticking slightly higher, 4.16% in October, and remaining unchanged in November. And here's the deal, Jay. We know that the headline CPI is going to fall if and only if, because of what we've seen with gas prices. I'm sure you're benefiting from it. I'm sure you're, the folks who are watching this and their clients are benefiting from that as well. A little extra pizza money, beer money in the pocket, as we like to say when gas prices fall. But it's the core CPI that is going to matter. The Fed is going to be watching that like a hawk. And if we don't see any meaningful improvement, and by that I mean lower than the 4.1%, the market's going to have to start to rethink the prospects for a December rate hike. Remember what Powell said last week. They will not hesitate if they need to do more. So that's what I'll be watching for. And if it comes in line, some rethinking. If it comes in ahead of that 4.1% for the core CPI for October, Jay, the market is not going to like it. And, my understanding is that the market, particularly mega cap stocks, are overbought here. It could be looking for a reason to give back some of those gains. That would certainly give it such a reason.
So, Chris, over the years, you and I have had some healthy debates, mostly offline, about the validity of using core CPI or inflation data when real people in the world are struggling. And it seems to always be used to drive. It seems to be used to drive a narrative. People are struggling to pay their bills. Car insurance, health insurance, food is through the roof. And now some talking heads with plenty of money in the bank who aren't hurt by inflation are going to come out and start saying, oh, inflation's not that bad. Chris, I don't use vulgarities on this show, but now I am. It's the government peeing on you and telling you it's raining.
Look, I'm not going to debate that, right? The fact, let's just look at it this way. We have yet to see any deflation. So this whole call that inflation is slowing means that prices are rising just only at a slower pace. So for people that are living paycheck to paycheck, folks that have, are participating in record level of credit card debt with some of the highest borrowing costs ever for that, shrinking their disposable income. Yes, Jay, you are correct. Is core CPI not a good barometer? Yes, because it, and you and I have talked about this, it excludes some of the categories, food and energy, that really hit consumers pretty hard. And what did we just see? Oh, record beef prices, right? So, of course, you have to factor this in. I only mentioned core CPI because A, it's one of the data points we get this week. 2, it's what the Fed is looking at. So we, of course, have to pay attention. But, as you have pointed out, we do need to understand the shortcomings of the data, which is why, do we ever hang ourselves, Jay, on any one particular data point, any one particular data set? The answer, of course, is no. We triangulate 3 times as much as we can, right, to get a full picture of what's going on. So, as I'm thinking about the core CPI report and what it says, last week's consumer credit report, very, very, very important for me. But what the retailers are saying this week, we get a see of them about traffic, about what their average ticket is, basket size, right? Where are they shopping? All of this is going to be very revealing. And yes, I don't sit, in the, the 4 walls. I actually go out into the world, and when I do, I try to be observant. Last weekend, TJ Maxx's Home Goods, packed, and they were packed with fresh holiday shopping product. I was in Walmart yesterday. Bonkers, simply bonkers inside of Walmart, with people buying all sorts of stuff, but more so staples and grocery than anything else. Not a lot of holiday shopping there yet. And then I was also out at a Simon Properties outlet mall, and holy cow, were people shopping. So people are looking for ways to stretch their dollars ahead of the holiday shopping season. Look, we all want to give our loved ones something special, right? But, again, the return of student debt, the return of higher borrowing costs, sapping our disposable income, people are going to trade down. And, as an investor, I continue to like Costco, for example. I think Amazon's going to be a big winner this holiday season. We'll see about some of these other retailers. I am nervous about, clothing and apparel. I don't, the data of late, people have not been buying it. My concern is that we see another repeat of an inventory build going into 2024 from those companies, whether it's a Gap, for example, maybe Target. They have some excess inventories built up.
2 reasons I've always enjoyed our conversations about economics in the markets is that you're open to other people's opinions, and you actually do boots on the ground, real research. The anecdote.
Yeah, well, you have to. You can't
support what you're doing. Yeah. So along those lines, like my friend Kevin Simpson over at Capital Wealth Planning, he's calling for higher for longer into 2025 potentially. And I'm starting to see some of those calls. And I don't do predictions. I don't care about predictions. But here's what I'm seeing, Chris, in the real estate market in Atlanta, which has been ridiculously hot like other parts of the country. Homes that are going up in my suburb of Atlanta, it'd be called an affluent suburb, they're not moving. So they're sitting there. And now we're starting to see prices coming down. So the long-term benefits of this, when you think about the millennials who can't buy homes and what it costs, that it could have at some point, and I'm assuming this was Powell's design, some second derivative effects of bringing down housing prices so other people can get into the market.
Yeah, I think that's right. I mean, I live outside of Washington, D.C. in Northern Virginia. It's a very different type of housing market. Virginia's a pro-business state, so they're done a very good job of attracting companies and corporate headquarters. But we also have the federal government, right? An entity that I don't think has ever done layoffs. I could be wrong on that. Job creep, call it what you will. So our housing market is pretty insulated. So I don't really see that, Jay. If anything, homes go up and they get sold pretty quick. So fortunate on that. But look, I agree that when you look at the housing market, you need to understand the multiplier effect, particularly what the single family housing market has, because there's all that goes into building the house. And once it is sold, there's everything that goes into furnishing that house, right? So, it's not just, wood and copper and sheetrock, right? You've got to get rugs, you've got to get wall coverings, you've got to get, furniture, electronics, all that stuff in there. So, to the extent that the Fed is successful, your words, slowing the housing market, that's a nice way to help slow the pace of the overall economy.
Yep. If they could just bring down food prices. That's what I would like to slow down the growth rate, but the actual bring them down.
Yeah. I mean, deflation in food would be great. But, other than fresh food, I can't remember the last time I saw a consumer product company or consumer packaged goods company, CPG to get the lingo right, bring down prices, right? I've seen packages shrink, right? Coffee is now 10 ounces, not a pound, which is kind of, remarkable to me. So I don't know that we're going to see, we will see some prices come down. Yes. I don't know that we're going to see a lot of prices come down.
Chris, I was speaking to an executive here in Atlanta in the retail food space, franchises, and he's a supplier to them. And there's a lot of concern he's saying, so this is subjective, that over the next 12 to 18 months, 20% of the restaurants could just end up going out of business because the margins aren't there. And at some point, the consumers aren't going to be able to afford those meals. What are you seeing from a macro level as it relates to the retail food space?
So far, restaurant spending, dining out has held up pretty well. What I have seen though is certain cutbacks, like people are not getting drinks as much, right? It's, soda, water even. But there are some concerns about the restaurant space, particularly at casual dining where, you sit down, someone comes and waits on you, all this other stuff. That the continued pain, if you will, is going to force a trade down. But even there, you take a look at 2024, we're going to get a number of wage increases by various states, 4 to 6%, some a little higher than that. California is actually very aggressively raising rates for fast food workers to $20 an hour from $15.50. So I definitely agree with your source, as it were, that restaurants are going to feel a lot of wage pressure. But you also step back. I don't think it's just restaurants. You take a look at what the Teamsters were able to accomplish, what the UAW is looking to accomplish. We've had other strikes, like out in Las Vegas, for example. We've seen walkouts by pharmacists and other things. There seems to be a sense that wage pressure is going to be with us for some time, and I'll tie that back to you and your call that higher for longer for interest rates. I think that ties back to it very well, because these companies will have to push through other price increases. We're already hearing it in the fast food industry, right? Chipotle has announced another price increase. We know there will be others coming in 2024 to offset those higher wages. So I think the path to get inflation down to that mythical 2% target is going to be a long one.
Yeah, Paul Tudor Jones was on CNBC last week or the week before. Very smart investor, trend following. And he says, again, I don't put weight into predictors, but he says, not only higher for longer, but higher rates will beget higher rates. And, any cursory review of what happened in the 1970s here in this country or other countries that were experiencing high inflation, they had that same experience. What is your take on what the investor community and the advisor community that serve those investors should take as it relates to their fixed income component of their portfolio as we head into next year?
Oh, that's easy, Jay. I don't, because I'm a dyed-in-the-wool equity geek. I don't really pontificate on the fixed income market. So I'm going to politely sidestep that question. In fact, Jay, you know who you have to talk to get insights on that.
So here's what I've been suggesting advisors do.
Sure.
For a while now, we've been building bond ladders, particularly in treasuries or munis, keeping them under 2 years, which is, it's an easy play if you know how to build a bond ladder. I'm finding a lot of lazier advisors are just using money markets, which is going to work until it doesn't work. Because the idea of having a fixed income hedge against an equity portfolio is when the equity market drops, interest rates will be brought down by the Fed, your fixed income assets would go up.
Right.
Great for your bond ladders, great for individual bonds. But for a money market fund, the only thing that's going to happen is you're going to lose all that yield. And remember the yield you were getting on your money market accounts from 2009 until about 18 months ago. So as a hedge, I think that's fairly important. So let's pivot. October retail sales report coming out. Is it coming out this week?
This week.
What are you looking for in that report?
Well, the expectation is that overall retail sales will rise, I think 0.7% month over month. Look, there's going to be some pull forward in that report. Remember that we had Amazon's October Prime event. We had competing efforts, Target, Best Buy, Walmart, and others. And I think, as I mentioned, we started to see some retailers pull forward their holiday shopping into very late October with Black Friday deals. So the report should be a positive one. But, the headline is the headline. We know, like I alluded to earlier, that gas prices have come down, so that'll impact gas station sales. So for me, I really have to get under the hood inside the report. I want to know, are folks continuing to eat out as much as they were? Are we seeing that slow? If so, to what degree? Are they pivoting back to grocery? Yes or no? Is that picking up? Department stores, are they still taking it on the chin? Clothing sales, given my comments earlier. But I think the big winner, Jay, for the month of October is going to be non-store retail sales. That's wink, wink, nudge, nudge, digital shopping. That speaks to, the Amazons of the world and those digital commerce businesses. And I continue to think that they will be strong players this holiday season. Even the NRF, National Retail Federation, says digital shopping will outpace overall retail sales. No surprise. I think Amazon is going to be the one that people want to own through the holiday season.
Interesting. And I want to get to some individual names. But first, could you tell viewers a little bit about the Action Alerts Plus portfolio, what you do there, and how they could learn more about it?
Sure. So the Action Alerts Plus portfolio, it's a portfolio that I'm lead portfolio manager at the Street. We've got a whole team of other people, everybody from Sarge Guilfoyle, Bob Lang, the wonderful Helene Meisler, Carly Garner as well, all kind of, helping contribute ideas and thoughts on where we are in the market, that sort of thing. So it's the Street's flagship product. In terms of investment style, are we a growth portfolio? No. Are we a value portfolio? No. What we want is exposure to areas of the market that are growing faster. What I mean by that is companies that are outperforming their respective industries. We also want to see earnings growth that is faster than the S&P 500. Why? Well, typically when we see faster EPS growth than the S&P 500, we tend to get multiple expansion that tied with rising earnings. tends to drive outperformance in terms of stock prices. In other words, creating alpha. So that's really what we look for, Jay. It's an interesting time of the year because we're starting to take a hard look at 2024. Just like clockwork, the consensus expectation for earnings growth next year is a little over 11%. We're sitting here today, 2 months left in the year, not really sure that forecast is going to make it. But again, we typically see the 2024 consensus start off the year plus, 10% or so. The reality is that, once we get into the December quarter earnings in January, companies really start to give their first hard guidance for 2024, or generally speaking, the coming year. That's when we'll start to see that forward view start to really kind of, become a little more realistic in what it's thinking about for consensus earnings expectations for the S&P 500. So we're going to continue to focus on companies that are poised to grow faster than the S&P 500.
Chris, where could investors and advisors learn more about the portfolio?
Oh, you did ask that. I would say that the best place to go is over at thestreet.com, or more specifically, you can go to aap.thestreet.com.
Let's get into earnings. We'll wrap up with this.
Sure.
So let's make this a lightning round. I'm going to throw out a name who have earnings coming this week. Tell us what you think we need to be looking for in less than 60 seconds. You ready?
I don't think I have a choice. Sure, let's do it.
Home Depot.
Oh, Home Depot. Want to find out what the repair remodel spending is. If we're concerned about new construction, are consumers continuing to open their wallets to do their projects? I don't think they will as much, Jay, because remember, there was a lot of that coming during the pandemic when people had to, reshape their home for what they were going to be doing, never leaving their home. So kind of curious about Home Depot. Not a big believer.
What are you looking for in the Walmart earnings this week?
Walmart, are they seeing consumers really flock to grocery? The reason being that is a draw. If people are trying to leverage lower food prices at Walmart, it means they're going there more often. That means their basket will continue to get picked up with other items. If not grocery, then I'm concerned.
What are you looking for in the BJ's wholesale earnings this week?
So candidly, I'm not looking anything for BJ's, but I want to pay attention to what it has to say in terms of membership growth and where it's seeing strength in its baskets. Again, food being a big category, I will be paying close attention to that because between the two of them, I prefer Costco.
Let's jump outside of retail. What are you looking for in the Cisco earnings this week?
So Cisco, networking spend and cybersecurity spend during the quarter, but going forward, what do they see companies doing in terms of digital infrastructure investment? We hear a lot of talk about, AR, AI, VR, all this other stuff. We need to have the network to support it. If they do not see vibrant spending on the digital network in the coming year, that's going to raise some flags.
And finally, what are you looking for in the Applied Materials earnings this week?
Applied Materials. Well, we really want to hear what they have to say about timing for reshoring of chip capacity, not just here in the US, but also in the Eurozone and Japan. I do think that they're going to give some good guidance on that. But the other thing too, though, Jay, is we're seeing the PC market start to turn around. The smartphone market is rebounding. AI continues to be hot in terms of chips, as is data center. I think they're going to give a bullish long-term outlook for overall semiconductor capital equipment need.
Excellent. So, Chris, let's talk about thematic investing for 2024 and specifically around some of your models.
Okay.
So when I work with an advisor and help them optimize their investing system, a lot of times we default to a core and satellite approach. Historically, before you and I met, the satellite approach had to do with some type of potentially alternatives type strategy or sector allocation. I really enjoyed getting to learn about thematic investing from you and the different ways to slice the markets. So as you look into 2024, which thematics do you think advisors should put eyes on?
Well, let's talk about what thematics are, first of all, Jay, right? Because as you and I have discussed many times, there's a lot of different spins on thematics. So let me just set the stage. To us, thematic investing really looks for multi-year structural changes that push on companies' businesses, driving revenue, driving profits, driving EPS, And again, this ties back to what what I discussed earlier. When you have all of that, it tends to drive multiple expansion, driving superior returns. So that's the concept for us. These structural changes, we're looking for the shifting landscapes of economics, demographics, psychographics, which really tie to the consumer, technology, and regulatory mandates. So that's kind of the spark notes, I guess you could say, on that. Areas that we're looking for. Well, look, we're going to continue to see a ramp in infrastructure spending, as well as the CHIPS Act coming on stream. So I think the Rebuilding America strategy is going to continue to hum. This is really focused on non-residential construction. So think of, the rebuilding of bridges, dams, roadways, and then layer in what we're seeing as a result of the CHIPS Act. I think that theme is going to continue to be strong. I do think we're going to see a lot of folks continuing to be interested in AI. Yes, Jay, we do have an AI model. My concern about that is there's always been a lot of hopium around that. What I want to see to really prove out the continued legs in that model are real concrete examples of AI and productivity and how companies are really starting to monetize that. We're starting to see some of that in, Microsoft is introducing its Copilot Office tools that have AI. We'll see what the adoption is on that and how they can leverage pricing. But, I think that'll be another good model going forward. And, given our conversation earlier, Jay, about the consumer, I do think that, what we internally call the cash-strapped consumer model is going to continue to work out.
So one of your models that I find fascinating is the nuclear energy and uranium model, only because if we do make this transition to a greener economy, to less reliance on fossil fuels, by default, that area is going to have to do well. So tell me, what types of names fall into that portfolio?
So it's the usual basket of what you're going to look for, Jay. There's no real surprises in there. But I agree with you, right? If we are looking to be a more green and sustained energy environment, and there's concern about continued fossil fuel usage, but also think about if we do make this transition to EVs, and I'm going to pause there for a second and say EVs are not just passenger cars. Right? There's other types of trucks, everything from, what UPS and PepsiCo are doing with their fleets to what heavy duty truck companies from, PACCAR, Navistar, Freightliner, Volvo, what they're doing. But there's also other vehicles as well. So when you amass all of this, the demands on the grid are massive. Mm-hmm. So I think we've got to, take a larger approach. And this one particular model on nuclear and uranium is, as you pointed out, and I agree, a viable way to think about supplying all of that energy that we'll need over the longer term. We're also starting to see, demand for some new facilities over in Europe as well. So I think this is, it's been a strong performer. It's kind of a sleeper performer. You don't hear a lot of talking heads on, the usual networks talking all about this, and sometimes we go where, again, where's the structural change unfolding? That's what gave rise to this.
How could viewers subscribe to your popular Thematic Signals e-newsletter?
Oh, that's very simple. You just go over to thematicsIgnals.substack.com and boom, you're there. Or you could just shoot me a note on Twitter at Chris J. Versace and say, hey, Chris, sign me up. And I'll be sure to dump your email address in there. And if you want to DM me for that, that's fine too. I totally understand if people don't want to put their email address out in the wild like that. I wouldn't do it.
That's right. And we'll have links to all that in the show notes. Chris, so much fun to have you back on Financial Advisor Television. If we don't talk before the end of the year on a show, have a great holiday season, my friend.
Well, you too, Jay. But why don't we just pick a date and make it happen?
Make what happen? Another show?
Yeah.
Man, so I have 2 kids, and like time goes so fast. So we're sitting here, what, 2 weeks, week and a half before Thanksgiving, and I know before you know it, it's going to be 2024.
Well, I'll offer this, Jay, and then you can think about this. Monday after Black Friday.
Ooh. Will you have some on the ground thoughts?
I probably will. We could even, if you want, just bump it a day later to that Tuesday, only because you probably want to catch Cyber Monday as well.
Excellent. Chris, thanks so much for coming on the show, my friend.
Happy to do it, Jay. Anytime.